Did you know that one bad investing decision can cost you thousands in the long run? And even worse, you might lose decades of potential growth. Whether you're just getting started or you've already made a few investments, the mistakes we're about to discuss could be holding you back from reaching your financial goals. In this video, we'll break down the top 5 beginner investing mistakes that could drain your savings and prevent you from building wealth. Stick with us till the end, because we're revealing how to avoid these pitfalls and keep your money working for you. Ready to stop losing money? Let's dive in. 1. Chasing hype and FOMO. Have you ever heard about a stock or cryptocurrency that's blowing up and thought, I should get in on that? This is one of the most common mistakes beginners make, chasing the hype. The fear of missing out or FOMO pushes many to jump into hot investments like tech stocks, crypto, or the latest AI trend, based solely on social media buzz. But here's the catch, these investments are often overpriced, and many beginners buy right before a correction happens. By the time the market shifts, they panic and sell low. This cycle of buying high and selling low can quickly wipe out your profits and even result in a loss. You end up losing money, not just on the initial purchase, but on the opportunity cost as well, since those funds could have been used in a more stable long-term investment. Instead, take a step back and do your research. Understand the business behind the investment. Don't just follow the crowd. Look at the fundamentals and ensure the company or asset is something you truly believe in. The goal isn't to jump on every trendy investment, but to invest for the long term based on solid reasoning. Doing so will help you avoid emotional decisions and place you on a steadier financial path. Investing is a marathon, not a sprint. Don't let social media and influencers dictate your choices. Instead, focus on your personal goals and risk tolerance. This way, you will make calculated decisions rather than falling prey to the next big trend. Remember, the market moves in cycles, and trends often fade. So, next time you feel tempted by FOMO, pause and ask yourself, is this investment really the right choice for me, or am I just reacting to the hype? 2. Neglecting fees and taxes. What's the real cost of a seemingly small fee? It might not seem like much to pay 1% versus 0.1% in fees, but over time, that difference compounds and costs you hundreds of thousands of dollars in lost returns. For example, on a $100,000 portfolio, that small difference in fees can cost you over $200,000 in lost returns over 30 years. Yes, you heard that right, $200,000. Taxes are another hidden drain. If you're not investing in tax-efficient accounts like a 401k or an ISA, you're letting the government take a chunk of your gains every year. Over time, that can significantly cut into your wealth. Taxes and fees may seem like small things to ignore, but they eat away at your potential without you even realizing it. The worst part is that you could be paying these fees or taxes without fully understanding their impact on your returns. The solution? Shop around for low-fee investments. Look for exchange-traded funds, ETFs, or mutual funds that have a low expense ratio. Many investors don't realize that a fee of 1% annually can eat up a large portion of their total returns, especially when compounded over the years. And don't overlook tax-efficient strategies. Contribute to retirement accounts like IRAs, 401ks, or ISAs that allow your investments to grow tax-free or tax-deferred. This is one of the simplest ways to protect your gains from the government's reach while also benefiting from long-term growth. By focusing on reducing fees and taxes, you're not just protecting your investments, but you're also positioning yourself for higher returns in the long run. The less you pay in hidden fees and taxes, the more you can reinvest, creating a compounding effect that leads to substantial growth over time. 3. Attempting to time the market. Can you predict when a market will dip? Neither can anyone else, not even professionals. The idea of waiting for the perfect time to buy low and sell high sounds great, but the reality is it's a losing game. Even if you wait for a market dip, timing the market correctly just once can be incredibly difficult, and trying to do it consistently is a recipe for failure. Did you know that missing just the 10 best trading days in the market can cut your long-term returns by nearly half? If you're out of the market during those big gains, you're hurting your overall portfolio performance. The market rewards those who stay invested, not those who try to jump in and out at the perfect time. It's easy to believe you can time the market perfectly, but historical data shows time and time again that staying invested is the winning strategy. Instead of trying to time the market, focus on time in the market. Stay invested and don't panic during downturns. The market has historically gone up over time, and by consistently investing in good assets, you'll see the best returns over the long run. Market dips are inevitable, but they are also temporary. As long as your investments are solid, the market will recover. This mistake can cause serious long-term damage to your portfolio. Missing out on key gains during major market rebounds due to fear or impatience can dramatically lower your returns over time. The key is patience, understanding that market fluctuations are normal, and investing with a long-term horizon. For lack of diversification, imagine putting all your money into one stock, or even worse, one industry. If that stock crashes or that industry faces a downturn, your wealth could take a huge hit. This is called concentration risk, and it's one of the biggest mistakes beginners make. Putting all your capital into a single stock or sector makes you vulnerable to huge losses if things go south. Instead, diversify your portfolio across different asset classes, stocks, bonds, real estate, and more. By spreading your investments, you create a safety net that helps protect you from big market swings. Diversification is your protection against major risks that could otherwise wipe out your portfolio. Diversification also helps you manage the ups and downs of the market. Different asset classes and industries respond differently to market events, so spreading your investments across various sectors can reduce the risk of a significant loss. Instead of focusing all your energy on one high-risk stock, look at industries that offer growth potential while being less volatile. A well-diversified portfolio will not only reduce risk but also increase the stability of your returns. If one area underperforms, the others may make up for it, ensuring you maintain a balanced approach. Spreading your investments across global markets and different types of assets is key to long-term success. 5. Investing without an emergency fund. Imagine being forced to sell your investments at a loss just to cover an unexpected car repair or medical bill. It's a nightmare scenario for many beginners, but it happens more often than you think. This is what happens when you invest without an emergency fund in place. Having 3 to 6 months of living expenses in an easily accessible account is critical before you start investing. Without this cushion, you risk having to sell your investments at the worst possible time, when the market is down. That means you're locking in your losses and missing out on the recovery. If you sell during a downturn, you lose out on the potential upside once the market rebounds. This could cost you years of growth. The solution is simple. Build your emergency fund first. Put it in a liquid account like a high-yield savings account so that you have access to it when you need it most. Once your emergency fund is secure, then you can confidently invest without worrying about short-term financial emergencies. This will protect your investments and give you the peace of mind to let them grow. You'll also be able to weather financial storms without being forced to sell your investments. Emergencies happen when you least expect them, and having this safety net in place allows you to handle those situations without affecting your financial future. Start by setting aside a small portion of your income until you've built up your emergency fund. And there you have it, the top 5 beginner investing mistakes that cost you thousands. If you avoid these mistakes and follow the right strategies, you'll be well on your way to building wealth and securing your financial future. Like this video if you found these tips helpful, share it with a friend who needs to avoid these costly mistakes, and don't forget to subscribe for more educational content on how to grow your wealth and make smarter investing decisions. Together, we can build a financially free future.